Good morning, everyone. My name is Katherine Wilkes and I'm an audit partner here at Gravita. Today I'm going to take you through the changes to the charities SORP. We've been waiting some time for this new SORP and finally it is here. It arrived on the 31st of October. So today we're going to be going through a few areas. So firstly, just a reminder on the purpose and the context of the SORP. Talk you through the key changes. It's known as SORP 2026. There are two very key accounting changes that we need to run through around leases and revenue, and then impact on trustees specifically, and then finally a call to action. So moving on to the purpose and the context of the SORP. So the SORP, this stands for the Statement of Recommended Practice, and this is the specific one for charities. It is a chunky new document, 310 pages long. It's split into very specific modules, and it is the guidelines for charities in the United Kingdom for their accounting and annual reporting. Now, it doesn't apply to all charities. It is just those charities that apply accruals accounting. So at the moment, and there is a bit of a heads up about this one, it's the charities who have gross income of £250,000 or more, but more on that to come. So periodically, the charity SORP making body will update the SORP. The last version was in 2019, 2015 before then. In actual fact, the 2019 version was, I would consider, a light update. But this is very much a full rewrite of the charity SORP. Now, we've been waiting some time. I think COVID got in the way of them writing the new SORP. And then also we were waiting for the FRS 102 update, the periodic update as well. So essentially, the SORP follows FRS 102, and FRS 102 has recently been aligned with IFRS in a couple of areas. The SORP is also designed to be more proportionate, especially for small charities. Talked about the big changes there. Leases and revenue are the two big accounting changes that we will run through as well. The new SORP is very much aimed at increasing transparency, sustainability and governance, and maintaining public trust and also comparability between charities. So who is responsible for ultimate compliance with the SORP? Well, I'm afraid trustees, it's down to you, although you might well delegate much of this to your finance team, to your senior management team. Okay, so let's start looking at the key changes to the SORP. There are three key changes. We've got, firstly, the tier categorisation. We'll run through the annual report changes and then we'll have a look at those key accounting changes. So the SORP 2019, our current SORP, has essentially two tiers and they're moving to a three-tier system. So at the moment, the key determining factor is gross income, and it's whether you are up to 500,000 or above 500,000. So you can imagine even charities that are not audited, and the audit threshold currently is £1 million, are still having to prepare a full set of financials and annual reports. And they could be quite relatively small charities compared to those massive national charities, Children in Need, Save the Children, that sort of thing. So this three-tier introduction offers a bit more proportionality for those charities in the middle. So there is tier 2 that gets added, charities where I should say gross income is between £500,000 and 15 million. And then we've got the additional tier 3, which is above 15 million. So why is this important? Well, narrative reporting is going to change depending on the banding level that you are in. There is additional disclosure in the SOFA, cost allocation, remuneration, all those things are impacted by the tiering. But what it also does is take some of the disclosure requirements out of tier 1. So that is also help. Just going to show you an example of the difference between some of the requirements within the narrative section. So here we've got SORP 2019. These are the requirements for all charities, I should say all charities that are above £500,000 in terms of the financial review section of the SORP. And over the slide, here we have the narrative reporting requirements for the financial review section of the SORP 2026. And as you can see, it builds up. You've got your Tier 1 section, which is actually quite extensive. You've got your Tier 2 section, which is all of those Tier 1 requirements and Tier 2 requirements. And then for those larger charities, Tier 3 charities, you've got that cherry on top of the cake with the Tier 3 reporting there as well. I can only recommend that you take a look sooner rather than later at all these changes, and then leave plenty of time to start redrafting your Trustees annual report, because there will be quite a lot of redrafting, especially those Tier 3 charities. So let's have a look at some of the other changes. So there are quite a few changes, and some of these are absolute musts. So they've made these changes to restructure for increased clarity and usability. So let's take a look at some of these. So impact reporting is a must for all tiers, although Tier 1 it is a lot lighter in the main achievement section. For Tier 2 and 3 charities, there needs to be more information on legacy recognition within the financial review. So you actually account for it in the numbers section, but you need to actually talk about it in your narrative section. All charities are now required to put in plans for the future, so a section on what you're going to do in the future. There's more detail that's required on outcomes and achievements. For Tier 3 charities, it's mandatory to add some sustainability reporting, so some key KPIs, governance, privacy, data security, that sort of thing. But it is optional for charities in Tiers 1 and 2, so you could add it if you saw it appropriate. There's increased guidance on reserves, quite a lot increased guidance on reserves, and that's in the financial reporting section. For Tier 3 charities, digital climate reporting, so climate related disclosures, especially if you're also a large company or large or medium-sized company under the Charities Act, sorry, I should say the Companies Act as well. New disclosures on executive pay are encouraged. And then there is also for all charities, all tiers, increased information on volunteers. So we're going to take a little look at volunteers specifically, and just show you, how this might impact you. So at the moment, it's quite light on describing how volunteers are used within your charities. So the new SORP requires more scale and nature of the roles of volunteers, and this is for all charities, and the input of volunteers. So for those Tier 1 charities, it is still light, but there is more recognition. But for Tiers 2 and 3 charities, there needs to be information on the number of volunteers, the activities that they are supporting the charity with, and also the contribution in terms of hours or staff equivalent, if practical to do so. And that might be difficult, but they are certainly encouraging some thought there. So you can see that this is an area that you will have to spend a bit more time on in terms of making sure you are SORP compliant. So there is some good news with the new SORP. So if you are in Tiers 1 and 2, you no longer have to prepare a cash flow statement. So it's only relevant to Tier 3. However, you must prepare one if you don't qualify as a small company and you are an incorporated entity under FRS 102. So there is a little bit of a catch there, but make sure that you check your limits. So we're going to move on to accounting changes, and starting with leasing. So the big change here is that this specifically affects operating leases. No changes to finance leases, and at the moment any lease, any operating lease you have, is charged to the SOFA as an expense. Section 10B of the new SORP now requires you to put this on balance sheet. So what this will mean is your assets will go up with a right of use asset, and you'll put your entire lease liability on there as well. We take a look at the components of the lease accounting. So you will initially recognise your right of use asset, and also your present value of future lease payments, which will be your lease liability. Now that'll be quite a complicated calculation, so don't underestimate that. So those two go on. And then each year you will depreciate your right of use asset, and you will essentially charge interest on your lease liability and also pay off your lease liability with your lease payment as you would normally. So, a little bit of different recognition within particularly the SOFA, but also the balance sheet. You're going to have some enormous numbers that suddenly go on there. So many charities lease their buildings, so it could have a really big impact on charities. So don't underestimate this area. However, there is some slightly good news. Not all leases are in scope. So if you have a lease that's less than 12 months left on it, or is low value, something like a computer, a tablet, furniture, they may well not be in scope and likely not in scope. If you have a lease on a rolling basis, again, that's something that may not be in scope. So in terms of things to consider, so the first thing to consider is your calculation. You need to put together a spreadsheet and calculate that present value of future lease payments that then forms your asset and your liability on initial recognition. So how do you do this? How do you go about doing this? So you need to review your leases, need to compile your leases, review them, work out what your non-cancelable period is, take a look at any extensions. Are they reasonably certain that that essentially becomes your term? You need to have a look at your discount rate as well. Now, the discount rate could be a really tricky one to identify. If there is a discount rate within the lease, that's fantastic. An interest rate within the lease, that's fantastic. But if there is not, then you'd need to look at, say, your incremental borrowing rate. Again, this might be quite tricky for a charity because charities don't always find it easy to borrow. So that could be a really sort of sticky point there. Also think about your metrics and the impact these might have. So have you got a loan or some sort of financial borrowing where you have to comply with covenants? If so, your covenants might change, and some of your reporting and say some of the numbers in your SOFA might change. So that's the sort of thing that you need to have a think about in advance, and what the impacts might be. A little bit about transition as well. So it's interesting how you will essentially approach this and transition to this new SORP, because the comparatives are not restated. You take any ongoing lease and essentially from the initial recognition date, which will be your initial application date of the beginning of the first period in which you adopt the new SORP, and you compile your numbers, your right of use asset and your present value of future lease payments, your liability, as at that application date. So hopefully that's a little bit of good news. Now, the SORP making body very helpfully recognise that this is going to be challenging. It is adopted prospectively, as we've just said, so no need to restate your comparatives. And the other thing to remember is don't forget that you need to, this is not just a one-time calculation. For any new lease that you enter into thereafter, you need to do the same calculation. And also each year you need to roll on the numbers and making sure that you are staying in line with your calculation. Okay, we're going to move on to revenue now. So revenue is section 5 of the SORP. And this introduces the 5-step revenue model that we'll go through in a minute. And I'm talking very specifically about revenue, but it may well, and exchange contracts, but it may well encompass some of the things that a charity does that you don't necessarily realise are captured by this new standard. So let's have a look at the 5-step model. So how you go about adopting this new part of the standard is you need to identify your contract, you need to identify the performance obligations within the contract, you need to determine the transaction price, you need to allocate essentially your transaction price to your performance obligations, and then you need to recognise your revenue as your performance obligations are met. So firstly, it's the exchange contract, and it's very specifically an exchange contract. And then you need to clearly work out what your performance obligations are. And then the transaction price could be quite tricky to determine as well. If you've got separate performance obligations that you don't sell, essentially sell separately, which again, fraught with complexity. Okay, so we've talked about it being an exchange transaction. Donations are definitely non-exchange transaction, not relevant and recognised as before, providing you've met the probability, entitlement and measurement test. Grants, now this is where things get more complicated. They could be either. So are they to transfer goods and services, or are they not to receive essentially an equal value in exchange? So if they are to transfer something, and it could be to deliver something in particular, then that would be caught by the standard. But if they're not to transfer something of equal value, then they wouldn't be. So I'm just thinking of some examples here. It could be, to deliver some training, whereas it might be a grant to achieve a sort of a higher level objective. Membership income, so a lot of charities are also membership organisations. Again, this could be either as well. Royalties, I think those are definitely an exchange. Need to think about how carefully you recognise those. Is it on usage? Is it over time? An area that needs to be assessed very carefully. In terms of the accounting policies, these need to be compliant with the new SORP and carefully thought through as well. So let's take a look at an example. So think about a training programme. This is funded by a contract, £100,000 contract, and your charity has been contracted to deliver 10 workshops over a 12-month period. So the old rules, you'll likely recognise this upfront when entitlement was confirmed, but under the new rules, your performance obligations are your 10 workshops. And you might deliver 8 of those in the first month and then 2 follow-up sessions later on. So therefore, your revenue would be potentially front-loaded in that first month, with some of your revenue as and when those last 2 performance obligations, those last 2 workshops are delivered. Other examples, so an annual ticket package to a stately home. So you might get an annual membership, and that entitles you to, at some point during the year, say a tour and an afternoon tea. And so therefore, you would have to recognise those, the revenue in relation to those performance obligations as and when the tour and the afternoon tea take place. Membership, this can be a bit of a grey area. It depends what you get in advance, if it's just being part of a membership organisation, or do you get something for it? Say you get access to a conference and say a monthly magazine. It's quite interesting. I've had a chat with a few charities recently, and they're very much saying, oh, well, the conference is for free, so therefore we don't have to change our revenue recognition. However, I don't think that is strictly true, because that is part of the performance obligations of the membership package. And so you would essentially recognise that portion of the revenue as and when the conference takes place, and the monthly magazine element on a monthly basis. So in terms of transition to this new part of the charities SORP, there is a choice. You can go back and restate your comparatives, or you can do it from the beginning of the year in which you first adopt the new charities SORP. It's absolutely entirely your choice. It's good that there is a choice, but essentially, if you choose the latter, which is putting it into the period in which you initially apply the new SORP, you do have to look at restating the opening balance and looking at all contracts that are ongoing, so you don't get out of doing that element of it. Okay, so let's just think about specifically the impact on trustees. So there are a few specifics here. So going back to the introduction, compliance with the SORP, trustees are ultimately responsible for compliance with the SORP. So you do need to get on top of all of this. There's a lot of enhanced disclosure requirements within the new SORP, and these might present risks, but also areas that trustees will need to manage and really think about if you're disclosing something. Strategic decisions as well must align with what is being reported. You can't just essentially write it down and not live and breathe it. It absolutely has to be true to what is going on within the organisation. And then the oversight of executive pay throughout the document. You need thorough documentation, and if you are going for some of those disclosures. So in terms of getting ready for these changes, and there are a lot of changes here. So the effective date of these changes is the 1st of January 2026. Work needs to start now, and that's not far away. So you need to start assessing your impacts. You need to determine how this will impact your financial statements. Will you need to reword any of your contracts or carefully word your contracts going forward? Will any of your operations be affected? Do you need to change any of your processes? There is a lot of training out there. Today is just one example of the training, and other material that you can take a look at. But is your team being trained on this as well? Do they have an awareness of the new charity SORP? Communicate early with your stakeholders is highly recommended, particularly banks where you've got covenants involved. Adopting early, now you can adopt this early. It doesn't feel that there's much time with the new standard coming out on the 31st of October and adoption, or should I say the implementation date of 1st of January 2026. But if you are, say, a March year end, the beginning of your accounting period in which this impacts you is the 1st of April 2026. So you won't actually need to show the changes to the charity SORP until March 2027. So you could, and there still is time for you to early adopt in your 2026 financials. You need to evaluate whether this is beneficial to your organisation. In some cases, it might be. In terms of your contracts, you need to start reviewing your contracts, and this is both your revenue and your leasing contracts. And you need to start building your templates. So, in terms of your revenue, your leasing one in particular, with your revenue contracts, you need to start identifying those performance obligations. You need to start working out what that fair value is, and need to start compiling any additional information you might need for your trustees' annual report. In terms of future-proofing, so are there any procedures you need to enhance in order to make it as smooth as possible in order to compile all of that information? And then, unfortunately, it's not just what I call a one-hit wonder. It's not something you just do on initial recognition of the new charities SORP. This has got to be a continual process. As and when you enter new revenue contracts, you need to continue to look at your performance obligations, your fair value, and the period with which you meet those performance obligations, and recognise it then on an ongoing basis. With your leasing, any new leases you enter into, you need to assess, do they meet the criteria for being recognised, and then go through your present value of future lease payment calculation to put that asset onto the balance sheet and your lease liability as well. And then finally, compliance changes. So the big one here is you will have bigger assets on your balance sheet. So does that mean you breached the audit threshold and unfortunately need an audit going forward? So what should trustees in particular be doing? Well, there are a number of updates in the new SORP that you absolutely need to get on top of. You might delegate this to your finance team, but trustees also need a good understanding of these changes and to make sure that the changes have been adhered to. And start talking to your finance team now, start talking to your auditors, start engaging in the changes, start putting together some timelines for when you'd like various things done. You might need to do some trustee training, you might need to do some finance team training. And as I said, there's lots of tools on the internet to help you. Put a couple of resources there. One is the actual SORP, one is a summary of the changes to the SORP, but also a couple of fact sheets that I find particularly helpful have been produced by the FRC. It's fact sheets 10 for revenue and 11 for leases. So in terms of the effective date, we've touched on this a few times, but just to run through this one final time. Effective date is 1st of January 2026. We literally are in the final countdown as we get to the end of 2025. But it is for accounting periods beginning on or after. And as I mentioned, for a 31st of March year end, this won't impact you until the 31st of March 2027. Early adoption is permitted, and there is also quite a helpful transition section in there. So comparatives for leasing don't have to be restated, and you have the option with regards to the revenue whether you restate or not. And then finally, I just wanted to touch on the charity law change that is coming up. Not only are we changing the charity SORP, but we're also introducing the 3-tier structure But aligning with that, we've also got some changes to the audit thresholds. So the audit threshold is increasing from $1 million to 1.5 million. If you do it on an income basis, and if you do it on an assets basis, it's going up to 5,500,000 income. Independence thresholds, so independent examination thresholds are going up from 25,000 to 40,000 as well. And then I touched on right at the beginning when we looked at the framework overview about the accruals accounting and the threshold being 250,000. This is actually going up to 500,000 to align with the SORP 2 categorisation. So that really is a whistle-stop tour of the new SORP, and I'm happy to take any questions. It's something that you really do need to start looking at now, but us at Gravita would be very happy to help with.